Hi, everyone. Welcome back to Seven Figures. In today's episode, I will be providing an update of the three portfolios: growth, dividend, and Bogleheads, or known as the balanced portfolio. Not much has changed in a week, but I wanted to get back on providing a cadence of regular videos on a weekly basis. We'll see that in some of our accounts, like the dividend portfolio, we continue seeing losses mount there. And then we'll see in the growth portfolio that we've actually seen our growth expand even more rapidly versus last week. And in the balanced portfolio, doing well, steady, closing the gap, almost flat for the rest of the year, almost flat compared to year to date. With that said, we'll go ahead and get started with the portfolio review. So let's go over there. Now, looking at the dividend portfolio, we can see that we're down 15.88%. Last episode, which was a week ago, this portfolio was down 14.95. So we've kind of actually gone down even more compared to last week. However, there's two factors playing into that. This portfolio is heavier on financials and energy as compared to the S&P 500. So a lot of companies, there was a rally in the market because there was talk of the economy opening up again, which is positive for a lot of businesses. But the banks reported their earnings last week and they got punished because they were first up. And their profits were smaller, like Bank of America, their profits were down 45%, but they were still profitable. They still made $4 billion. Wells Fargo made $1 billion in profit. And this is after they had to reserve a certain amount of money for future losses. If anything, this has actually been really positive, and I'm excited about the financials more than I was before. So we take a look here and see what's really been weighing down this portfolio. The dividends are still coming in. You can see $174 paid out since I opened this account in June of last year. We're down $908, which is equal to 15.88% based on how M1 Finance calculates it. But this is not a big deal. I'm looking at it right now. Bonds actually doing well just because, well, everybody's in bonds because they're scared. Financials are down 44.9%. But I plan on putting more deposits in the future on financials. Buy when stuff is cheaper. Don't buy when it's more expensive. This is kind of like common sense. Healthcare is up, rightfully so. Energy's down a lot. I probably will add to energy a little bit, but not as aggressively as I will to financials. In my own retirement account, I'm planning to add a lot to financials. Energy is still a little bit of a messy situation because oil prices are still under $20 a barrel. Probably not going to stay there forever. So if you see ExxonMobil or Chevron, I'm planning on buying those companies because they have the balance sheet to be able to actually ride this out and get out to the other side with cash, or be able to actually sell their oil for more money, get into positive cash flow, pay back the debt, and continue paying the dividend. Everything else in here is kind of a mess a little bit. I would say utilities are probably the one area where you can go hide out for dividends also. But consumer staples depends on what company. Industrials have taken a big hit, obviously, because many of them are not considered essential. You've also got GE being down. Boeing is down because they are all in aviation. Communications, surprisingly, is down. I don't know why, because I really do think communication is a good area. We're not going to cut off our cable anytime or internet anytime, so we're going to continue paying those bills. Right after the housing bill, the next thing is, electricity, and then after that, it's usually cable internet. So those companies will be just fine. If anything, I would say financials are going to be where I actually put more of my money. The dividend payout right now is close to 6 or 7% for some companies. You look at Wells Fargo, the dividend payout right now is 7%. That's the yield. Wells Fargo is going to be just fine. Bank of America is 3.5%, I think, and J.P. Morgan is close to 4%. Those companies aren't going anywhere. And for that reason, I turned off my auto invest here because I want to get the money coming in here and actually direct it myself to the financial stocks first. So that's really it for dividends. Let's go ahead and take a look at the growth portfolio to look at the other side of the coin. Now, looking at the growth portfolio, it's a totally different story. When we see the growth portfolio's growth numbers from last week to this week, it's gotten even stronger. Last time I did an episode, which is 5 days ago, it was up 15%. Well, now it's up 36%. And there's no secret about it. In this portfolio, there's one company that's really running away with growth, and that's Tesla. But you can see this portfolio has actually been higher before. It was up to, this level up here, much higher than this. It was up 65% back in February, almost 70% back in February. So, and it's also been the one that's gone down the most before. It's gone down as much as 18%. So it swings a lot more. It's more volatile, but that's also because it's got a lot of potential. This is one of those portfolios that I'm gonna not even try to sell into the companies. They're all still in their growth phase, and we can see down here, Tesla is up 275%. Tesla is not only my biggest position in this experimental portfolio, it's also one of my biggest positions in my semi-retirement portfolio that I have at Vanguard. I bought like 150 shares of Tesla there with a cost basis of $250. It's gone up, up to $900 at one point, which was really crazy. But also in here, you can see that we only put in a little bit of money, and now it's almost $3,000. But other things are doing really well. It's not just Tesla. You can see Amazon's doing really well. Beyond Meat is one of the few that's actually down a lot, but I'm not even worried about that. I'm putting more money in there, if anything, because it's almost down to close to where the IPO came out, which was $25, and immediately jumped to $70. And now it's been hovering around that area. So I'm buying Beyond Meat even more than I did before. Facebook is down. Not really adding too much there, not because of anything negative, but just because not my focus right now. Microsoft has done really well, and they're going to continue doing well because those of us who are working from home, we're using Teams even more. We're using Office 365 even more. So these companies all have big moats, and they have basically they're not affected by crisis or no crisis. They're going to do just fine. They're monopolies in their space. Google in search is going to continue doing really well. And another one of my favorite companies, AMD. Again, another one of those companies that I have a big position in my semi-retirement account. Not as big as I wanted, but I bought about 500 shares of AMD back when it was $15 a share. So you can only imagine how much. I think I've tripled or quadrupled the money that I put in there. And they're going to continue doing well because they're taking Intel's lunch. They're taking share from NVIDIA. So they're doing really well. Netflix, I remember when everybody was saying streaming is dead, Netflix is in trouble, blah, 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 about how, what was it called? Disney's going to come in and take their business. Netflix is doing phenomenal. I use this company. This portfolio is really companies that I use. I use Uber all the time. I'm going to continue buying shares in Uber. I like this company Invitae, because they do DNA testing and they do all this stuff that's really unique. They touch our lives because you have a baby. They've likely done a NIP test to find out genetic disorders on your child. So every baby is going to have that done on them at some point in their lives. And they're helping change lives. AMD, use their products, love it. Alibaba, don't use their products, but I know that pretty much in China, that's their Amazon, right? Microsoft at work, that's the workhorse. I use Microsoft all the time. Facebook, pretty much all my family and friends are on Facebook in some way. I use WhatsApp. I'm not a big fan of being on Facebook. I don't post anything, but I use WhatsApp, and they're gonna monetize that soon. Beyond Meat, I've pretty much switched over to that instead of eating real meat, just like I switched over to soy milk instead of drinking regular milk. Amazon, I use Amazon a ton. Pretty much when I can't find something easily, I just hop on Amazon. And Tesla, I wish I could buy a Tesla tomorrow. I would actually absolutely buy one immediately. So really like these companies. It's concentrated, and it really goes back to what Warren Buffett says. You only got to find a few really good companies and put your money in them. You don't find a million companies. As you can see, this portfolio only has 11 stocks. The dividend portfolio has 60 stocks, and this portfolio is blowing it away right now. I think the dividend portfolio one will actually catch up to it eventually and maybe even do better in some cases. But if you're looking for real growth, I mean, buy what you know. I know these companies really well because I use all of their products. So that's really it for the growth portfolio. Only thing I'm going to do here is as I add money, I'm going to try not to overload like Tesla as a position and instead look at maybe adding a little bit of money in a company like, Invite. So that's really it for the growth portfolio. We'll go ahead and switch over to which is the balanced portfolio, or I call the go-to portfolios that I recommend to family or friends who do not want to know anything about investing or don't know anything about it, are nervous and scared of doing it. Ask me any questions. The first thing I'll say is, you know what? Here's a two-fund portfolio, 50-50, and set it and forget it. Don't ever look at it. Don't look at the markets. Uh, put it in direct deposit and automatically have money going there basically every week or every 2 weeks or every month, whatever cadence they want to do. This is the portfolio I usually recommend for them. And as you can see, it's now down 0.13%. Last week it was down 1.31%. So it erased a percentage point, more than a percentage point, pretty much lockstep with the market. A little less because obviously it's 50% bonds. And what we can see is it's actually outperforming the S&P 500 year to date. So if you had your money in this kind of fund, you'd be ahead of the S&P 500 year to date with very little stress, because it never really dropped that much and it's not going to go up a whole lot. As you can see, steady as she goes is all it does. It doesn't really go very far, very fast, very far. It doesn't go down fast either. It goes down slow, it stabilizes quickly. And when we look down here, it's just two funds, right? You've got the total bond market and you get the total world stock index fund. So right now, the bond market's up 8.46% because everybody panicked and ran in there. The stock market is down 8%. So they balance each other out. I continue to collect the income. And then as the economy opens up again, what we'll see is the bonds will start to lose their value right down here. We'll see the bonds start losing their value. And the stock part will actually start gaining value. But it'll, just like it is right now, it'll be back in balance, maybe a little bit more because stocks do go up faster than bonds do. But I would have collected the income that I was looking for from the bonds, and I'd be happy with that. As I said, with this portfolio, not looking for much. This could even serve as an emergency fund portfolio, to be honest, because it's not gonna wow you. It might return, 5 to 6% a year on average, but that's sufficient. That's beating inflation. That's beating leaving your money in the bank account, and it's not gonna drop too much. As you can see, market gains negative 124, but earned dividends of 116. So those dividends are locked in though, right? They're not like market gains. You got them, you booked them, they bought more shares for you. So that's what I love about this one. That's really it for the Boglehead portfolio. And actually for this video, because today I just want to focus on giving you an update, get back on a cadence of making videos on a regular basis. And I'll try to pick a topic for next week. Maybe I'll pick a stock or a specific topic to cover more in detail on the next video. If you like the video today, please give me a thumbs up. If you love the concept, I would appreciate if you subscribed. Thanks very much. Have a good day and stay safe.